Imagine you're piloting a state-of-the-art aircraft through a treacherous mountain pass. The weather is turning, visibility is dropping, but your instruments are your lifeline, feeding you a constant stream of critical data. Suddenly, all your instruments go dark. Your GPS, your altimeter, everything. You are, in the most literal sense, flying completely blind. This isn't a movie scene. It's a precise analogy for what a US government shutdown does to the financial markets. This is the government shutdown glitch, and it has unplugged the very instruments the Federal Reserve and every investor rely on to navigate the economy. The true danger isn't the political theater you see on the news. It's the deafening silence. The shutdown has created a data blackout at the worst possible moment. Historically, investors have often dismissed government shutdowns as minor bumps on the road. The thinking is that the economic damage is small and temporary. But that view is dangerously simplistic this time. The primary threat to your portfolio is not the direct economic cost, but the sudden and complete stop of vital economic data. Agencies like the Bureau of Labor Statistics have been forced to completely cease operations. This means the gold standard of economic statistics, the data that forms the foundation of every major financial decision, has been cut off. The monthly jobs report, postponed indefinitely. Key inflation reports, like the Consumer Price Index, also on hold. The timing of this data blackout could not possibly be worse. The US economy is standing at a fragile and uncertain crossroads. Is the recent weakness in the job market a sign of a coming recession? Or is the economy strong enough to bounce back? The now delayed jobs report was supposed to help answer that question. Without it, we are flying blind right as the economy could be turning. This transforms the data delay from a mere inconvenience into a primary source of systemic market risk. And this data blackout has a direct and deeply unsettling consequence for the one institution that matters most to the market right now: the Federal Reserve. The Fed has a dual mandate. The government shutdown has just severed that wire. With the data-producing agencies shuttered, the Fed is left without the information it needs to make sound decisions at its upcoming meeting. This creates an extraordinary dilemma. The market's powerful rally has been built on one key assumption: that the Fed will continue to cut interest rates to support the economy. But the Fed has signaled that any further rate cuts depend on seeing clear evidence of a cooling labor market. The shutdown halts the release of the very data that would provide that justification. So what does the Fed do? Cut rates based on incomplete data? Or hold steady and wait? History suggests they will wait. During the 2013 shutdown, a lack of information was a key reason the Fed decided to hold rates steady. And this is the central glitch for you as an investor. The market has already priced in a rate cut, but the shutdown itself is the event that could prevent that rate cut from happening. This could trigger a sudden and severe market correction. The very foundation of the recent market rally is now threatened by Washington's gridlock. So, what can you do right now to protect yourself? Here is your 3-move countdown to portfolio protection. Move number 3. Broaden your horizons. First, recognize that the current government shutdown is a uniquely American problem, born from our own domestic political gridlock. This highlights a specific risk for investors who are heavily concentrated in US assets: governance risk. When the world's largest economy can't perform a basic function like funding its government, it sends a damaging signal to international investors. This erodes confidence and could accelerate the flight of capital away from US markets as investors seek stability elsewhere. The strategic implication for you is clear. It's time to look beyond the borders of the S&P 500. Consider high-quality international companies in developed markets like Europe and Asia. These businesses are less dependent on US consumers and less exposed to American political dysfunction. And most critically, consider an allocation to gold. Gold's recent surge is a direct response to this rising uncertainty. Gold is the ultimate non-sovereign safe haven. It tends to thrive in environments of US dollar weakness and economic uncertainty. Precisely the conditions a prolonged shutdown can create. Take a moment right now and look at your own portfolio. How much of it is invested outside the United States? Do you have any exposure to real assets like gold? If your portfolio is 100% US stocks, you may be taking on more risk than you realize. Click the link in the description below to download our free guide, The Global Escape Hatch, which details 5 international markets to consider. Now for move number 2, fortify your core. Before we talk about any specific stocks, we have to address the single greatest threat to your portfolio during a crisis: you. Decades of research have proven that during times of high stress, we are not rational beings. We are driven by powerful emotions that lead to disastrous financial decisions. As Warren Buffett famously said, the most important quality for an investor is temperament, not intellect. Think of your rational mind as a small rider on the back of a large, emotional elephant. In calm times, the rider can guide the elephant. But when a crisis erupts and the elephant is spooked, its immense power takes over and the rider is just along for the ride. This is what happens when an investor sees frightening headlines and a sea of red and engages in panic selling at the absolute worst possible moment. The antidote is to have a system. Constructing a defensive, all-weather portfolio core is that system. It provides a psychological anchor in a storm, making it easier to control that emotional elephant when panic sets in. This process starts with an allocation to defensive sectors. These are industries whose products are essential to daily life, so demand remains stable regardless of the economy. Think of consumer staples, companies that produce food, beverages, and household goods. People need to buy toothpaste and soap whether the economy is booming or busting. Think of healthcare. The need for medical care is non-negotiable. People get sick and require medicine regardless of political gridlock. And think of utilities, companies that provide electricity, natural gas, and water. People must keep the lights on. Beyond sectors, and they have good, consistent cash flow, which is the lifeblood of any business and a sign of a sustainable and efficient model. Now for the final and most immediate step. Move number 1. Deploy strategic shields. Think of this not as market timing, but as buying a temporary insurance policy for your portfolio. The most powerful and underrated tool available to every investor is cash. Cash serves a critical dual purpose. First, it acts as a zero volatility anchor, reducing the overall swings in your portfolio and providing a psychological buffer against panic. Second, and just as importantly, cash provides dry powder, the liquidity to take advantage of opportunities that arise when fear drives prices down. During periods of high uncertainty like this, it's prudent to increase your strategic cash allocation slightly, ensuring you can both weather the storm and capitalize on the aftermath. For investors seeking a more direct form of portfolio insurance, the protective put option is an invaluable tool. A put option is a contract that gives you the right, but not the obligation, to sell a stock you own at a predetermined price, known as the strike price. It effectively creates a price floor, capping your potential downside risk. Imagine you own a stock trading at $150. You're worried it might fall, so you buy a put option with a $140 strike price. Now, no matter how far the stock falls, you have the right to sell your shares for $140 each. Your maximum loss is capped. If the stock goes up instead, the option simply expires, and the small price you paid for it, the premium, was simply the cost of peace of mind. It's a powerful way to build a temporary shield around your portfolio during a specific period of identifiable risk. Let's bring it all together. The government shutdown glitch has created a data blackout at a moment of peak economic uncertainty, leaving the Federal Reserve flying blind. But navigating this environment simply requires a clear, disciplined strategy. First, broaden your horizons by diversifying internationally and considering gold. Second, fortify your core with defensive sectors and high-quality fortress stocks to manage your own emotion.